Hello, and welcome back to Fang Fridays. I'm Chris Healy, the CEO of Strategic Analysis Corporation. In the next few minutes, Ross Healy, chairman of SAC, is going to use the principles of structural valuation analysis, our unique methodology that combines technical with fundamental analysis to discuss and analyze the so-called FANG stocks. If you want to learn more, visit our website at strategicanalysis.ca. See our videos, understand our methodology, and learn more information. Now, without further ado, I'll turn it over to Ross.
The first stock we're going to review is Amazon, and there is no signal from week over week. The stock has not done anything of any interest. It's just basically gone sideways. The second stock I want to look, however, is quite interesting because last week and the week before, we had observed that Facebook had actually broken out over its MSG price, that's 5.5 times book value, and looked as if it was heading back up again to its usual high, its bubble price, or 7.4 times book. However, a funny thing happened on the way to the forum. The structural price did not hold. Now, the stock appears kind of reluctant to let go at the present time, and it's pulled right back up to the MSG price. And we now have to wait and see whether we have a buy signal which got temporarily rescinded, and it's okay, or whether we had a false breakout. Well, that's not for this week to decide because the stock is right there. Here's Alphabet. And Alphabet, of course, became a sell signal really when it came up again to its low super growth price. That's 4.5 times book value and has fallen away. That has been pretty much the top of the range for this company. Here is the 10-year structural price range for the company, bounded more or less by that low super growth, the LSG price, 4.5 on the top, and occasionally getting down as low as the mid-growth price, that's 2.5 times book. But notice most of the time the stock really fluctuates around its fair market value. That's that dotted line. The next stock we want to look at is Netflix, and again, there's nothing much to say here. We have had an avoid on this stock for some period of time. It's been banging up against its HB5 price. That is about 26 times book value, but hasn't been able to get anywhere for a long period of time and remains in a kind of stasis. The next one that I want to review is Apple, and remember what I said about Apple, and that is to say, if we go and take a look at the very long-term 10-year price chart of the company, we see that for most of the period, Apple always peaked out precisely at its MSG price, that's 5.5 times book, until the company bought back stock. And the stock made what we call an inadvertent breakout. That is to say, the price didn't do anything, but the structural price fell away. Well, the stock then proceeded to run right up and just a little bit beyond its fair market value. And look at that going back for the past 10 years. The fair market value has been a pretty good boundary for that stock all the way through. Well, in the market setback in December, the stock went right back down to, yes, its MSG price, the usual top. And also its fair market value, and there it's pretty much peaked out. Now, the most recent earnings results and sales results were absolutely awful. And I have no comfort with this stock whatsoever in my portfolio. I think this stock is going lower, and I would avoid it. Well, we then took a look at NVIDIA. And NVIDIA was doing something, it kind of, the stock rolled over, if you like, and set back to its HB1 price. That's about 10 times its book value. And it looked like the stock may have become a buy, except that, you see that? The stock kind of crept under the HB1 price. That was as late as last night. Well, very clearly, I think the market was anticipating some pretty awful numbers and was already trying to signal the fact that the price will head lower. Well, what happened? Sure enough, the sales were brutal. They were off 30%. The earnings were frankly no better. However, they beat the consensus earnings number for the quarter, and the stock went wild. In fact, in after market trading, the stock traded up as high as $175. Well, the problem is, of course, that the results were awful. And so, despite the fact that it traded up here, by the time that the stock opened, it had traded right back down to its HB1 price. Again, 10 times book value. And the question at this juncture is, what is going to happen to the stock next? Well, if we look at the price of Bitcoin, perhaps there's going to be a renewal of Bitcoin mining, and therefore there will be a demand for NVIDIA chips. I don't know. The market doesn't know either, and right now it is delivering, as it closes tonight, no signal whatsoever. If I was a betting man and looking at the awful results, I would say the stock is probably hitting lower, back down to 125, but I cannot be pedantic about that because that is not verified by the market as of yet. To get a verified sell, we like to have what we call the 3% 5-day rule. The stock should fall below the breakpoint by 3% and remain there for 5 days. Well, that is not the case right now. On a positive side, Boeing, which also gave us a lovely sell signal on the all the Max 8 stuff, tried to break out, tried to break back again. See that? It broke here and then drifted and finally got down to its next lower breakpoint price, and there it has had a rebound. We would be watching that HB7 price very carefully. That's about 44 times book value, very carefully to make sure that it holds. But until it does, we would have to rate the stock as a hold and even a possible buy. Let's finish up by taking a good look at Tesla. Sometimes included in the sort of the Fang 10 group of stocks. But I'm particularly interested in Tesla because the stock has broken below its bubble price. Again, 7.4 times its book value. And look at the trend of earnings, a down, down, and down. Let's take a look at Tesla in rather more detail according to SVA. This is a long-term chart of the company, and it's quite interesting for 2 or 3 reasons. The first is that if you look at the fair market value as forecast by the analysts, it really hasn't gone anywhere in 5 years. There's been an uptick here when people, I think, expected that their auto sales and profitability would be better than they do think it now. And that is falling off a little bit. But let's take a look at those structural lines of ours. Okay, see what happens here. Okay, we've got a jump, goes flat, jump, the line goes flat, jump, flat, jump, flat. What this is a company which is raising money not by growth and by retained earnings, okay, as, let us say, Alphabet is. Here you can see how smooth those lines are, the quarterly growth, quarter and quarter and quarter. But when we look at Tesla, we see that the only way that they have been able to grow their balance sheet has been by issuing more and more equity. This is a company that we call a Wall Street miner, or if it's in Bay Street, because we have some of these here in the Toronto market, we would call it a Bay Street miner. They don't make money for what they do. They make their money on raising cheap equity capital. So this is a clear signature of a Bay Street miner. The problem in my experience with Bay Street miners is that it gets not so much more difficult to raise money, but the market eventually sees through them and says, well, can't you do better than that? And eventually the valuations collapse. I'd like to take a look at this chart in an entirely different way. And to do that, I'm going to click on this little tab right here, Price to Book. And when I do, what we're going to see is the values of all of those bubble prices. Okay, these are all power law multiples of book. And there are the precise values. But when we look at Tesla, what we see is an erosion. Basically, what we see is a bubble. We call this the bubble zone, and this is a bubble, and the air is coming out of the bubble. And I don't know whether this is the final straw, but my guess is that it probably is, that this stock is heading lower. I would not be in this stock for all the tea in China. I think the stock works lower. So that concludes our review of the FANG stocks for this week. In summary, I have to say, whatever else you want to say about the rest of the stock market, I hope that you can see that the FANGs themselves are looking pretty iffy right now, with the possible exception of Amazon, and we have yet to see whether Facebook is able to recover or not.
Thanks for joining us, everyone. Tune in next week when we review the FANG stocks to look at what happened during the week past and what we expect going forward. In the meantime, if you're interested in learning more, go to our website, strategicanalysis.ca, where you can download the first 3 introductory chapters to our book, Inside the Stock Market, where you'll learn in detail about our approach and methodology. Our service tracks over 4,000 North American securities. So for almost anything you own, you can get our in-depth analysis. Our clients consistently use our system to improve their own results and avoid unnecessary losses. You can too. This has been Chris Healy, CEO of Strategic Analysis Corporation, reminding you that nothing, including investing, is difficult if you have the right tools.